And thank you to the audience for being here and spending a little time with me this evening. I appreciate your time. We're going to talk about something pretty riveting today, which is financial statements. Jeffrey, with your permission, I'll share my screen. So here we go. Okay, so a little bit about me, just as a recap, and I won't spend a lot of time going through what we talked about in the program, but just for any of you that are new, this is a fun picture of the Oregon City elevator, 1955 on the left side of the screen, as it stands currently in 2024 here. And our office is uniquely located at the top of this wonderful elevator, so we're always thrilled to come to work and experience this unique setting. So what we covered last time, real quick, we talked about why we should have the playbook. We talked about how to assemble your playbook. We talked about kind of the big overview of what's in the playbook, and then we tackled the first section, which was goals and objectives. So tonight, we're going to dive into what I think is kind of the cornerstone or foundation piece of the playbook, which is financial statements. So first, we'll kind of describe what financial statements are, and then we'll talk about how to create your own financial statements, and then how to deal with all of the statements that come in the mail. And your mailbox, like mine, is probably flooded with statements. So then looking forward, next week, we're going to talk about the legal documents inside the playbook, as well as estate planning section. And this is going to be fun, where we're going to talk about the context of how the playbook fits in, but we're also going to talk about stuff like probate avoidance, whether you should have a will or a trust, the power of attorney, healthcare power of attorney, things like TODs and PODs, and then kind of what you're going to need inside your playbook. So that's next week. And then finally, the last week of our 4-week section, we're going to deal with the insurance section, what you need to keep, what you need to consider. We're going to talk about Social Security and pensions, when to file, unique strategies, solvency, which is a fun topic about Social Security, as well as tax planning strategies. And really, why we all do this is we want to make our tax person happy when it's time to file. And then we're going to wrap up, and we'll have an extensive Q&A at that time. So last slide before I kind of jump into the main course, just a refresher of what's inside the playbook. So there's 8 sections, and it's a goals and objectives, financial statements, which we're doing today. And then a couple things that we're not going to talk about, but performance and miscellaneous are also sections in the playbook. On the right side of your screen, you'll just see a snapshot of our webpage, elevate615.com. And I want to point out that there's the book, of course, that you can buy on Amazon and order that. But there's also a few dozen videos on our website that you're free to watch that kind of take a deeper dive into each of these sections. So in addition to the course that we're running now, the book, you also have the website as a resource for you. Okay, so I thought I would start this evening by this inspirational photo of what your home offices could look like without a really good system in place to manage your paperwork. Now, obviously, I don't think it would ever get this bad for anybody, but I recall before we adopted the playbook and adopted the system that I had a few filing cabinets that were pretty full in my house. And one of the biggest concerns would be, well, when somebody has to take over for me, where do they go? What do they do? Do they run into this when they step into my office and try to take over? Or is there a better avenue for them? And that was really one of the inspirations for the playbook, was making sure that we had things set up in a manner that were easy for somebody when they take over. So hopefully your offices don't look like this. And if you stick with me, I can tell you that by the end of the playbook webinar, it certainly won't. So let's dive right in. Let's talk about financial statements. So I've got a picture here of a net worth statement, which is the first thing we're going to talk about. But when I say financial statements, what I'm saying is really something that I learned in undergrad business school, which is the statements that are generated usually by accountants to show the financial health of an institution. And there's 2 primary statements. There's the the balance sheet, which on the personal side we call the net worth statement, which is what we have here. And then there's a cash flow statement, or on the personal side, we might call it a budget statement, inflows and outflows. So we're going to apply those two methods of reporting for a corporation to our own personal household. And we're going to start with the net worth statement, which is the first statement that you're going to need and you're going to create inside of your own playbook. So this is my playbook. This is my net worth statement. I've got it tucked away in one of those little plastic binders. And I will tell you that I've been creating my own net worth statement since my days in college, nearly 30 years ago. So I've got them stacked up one on top of another. And it's kind of nice to be able to go back and see and have a record of what has happened over the last 30 or so years. Not quite 30, not quite there. But let's talk about the net worth statement first. By the way, if you were thinking, well, how do I create a net worth statement or where do I get one? Easy, right? You can do something as simple as handwrite it. You can download this particular spreadsheet from our website. If you're adventurous and brave, you can Google, free net worth statement, and I'm sure they're all over the internet, but pretty easy thing to do. The first thing that we want to do is recognize that this is a hypothetical example, and you can see, hopefully you can see at the very top, it says total assets, and then right underneath it says total liabilities. And then on the other side, on the right side, it says net worth. And so a net worth statement is simple, and you know this, it's just your assets minus your liabilities equal your net worth. So I tend to think of the net worth statement as like the bathroom scale. It gives us this figure and it tells us, kind of one number that we need to focus on. We'll keep that in mind. Now, when we build out the net worth statement, we're going to start breaking it up by section. So the first section that we have here is the liquid assets or short-term assets. And in this section, you're going to list all of your banking account relationships you might have. You might have a US Bank or JP Morgan or a credit union, and you're going to list the account registration and the rough dollar amount of what's in that account. Now, you don't have to have the exact figure because we know that those figures change every day, but it should be a pretty good approximation of what is in that account. Now, one thing I want to point out is that when you are labeling these, so this says bank accounts, and this one, if you can read it, says example bank account and registration. Really important to say something like US bank account, John and Jane. And then if it's a trust account, you might say family trust. Or if it's a TOD or POD, you might say TOD or POD. And we'll circle back to that kind of theme. But the more detail that we can add in this makes this net worth statement even more valuable to us. So again, the very first one is liquid assets. We're going to list the name of the institutions and the registration and kind of the title, and then a pretty good approximation of what the value is under value. The next section we go down to is going to be the longer term assets. And we separate these from our shorter term assets because sometimes longer term assets are the retirement accounts, the profit sharings, the Roths, the IRAs, the 401ks. So we call those longer term. It's nice to separate them out because they may not be as liquid as the shorter term. And I think the same principle applies here. You want to say stuff like, 401k for Jack, or Roth IRA for Jane, or kids UGMA account. So you want to be specific about the titles and the registration of the accounts, and then a pretty good approximate dollar value. Now, if you're a corporation and you are creating these for your company, you would want exact dollars because they have financial reporting periods. But for our household, it just needs to be a pretty good approximate value. So moving down, the next section down is the real estate section. So in this example, it says example primary residence. If there are more than one properties, you might use addresses, but then also use who owns it. Is it owned by the trust? Is it owned jointly? Is it owned singly? Is there a transfer on death designation? Is there a POD designation? And then what is the approximate value of that real estate? Now, so in this day and age, getting values of real estate is pretty simple. We can go to Zillow or another online site, type our address in, and get a pretty good valuation. We don't necessarily get hung up on whether it's the exact number or not because it's subjective. But getting an idea of what it is worth makes a lot of sense for us here. Once I was asked the question of, do I put my timeshare down on in the real estate section? To which I would reply, if that timeshare really does have a secondary value where you could sell it, it would go on your net worth statement. If it is something that primarily you would walk away from if you stop paying, the annual maintenance or service fees, it might not be worth having on your net worth statement. If it's something that has beneficiaries tied to it, it will pass to your children or a charity. Maybe you put it on your net worth statement. If it's something that disappears at your demise, maybe you don't. Finally, the last section on the left side of the column are the family assets. So these are going to be things like the automobiles, the toys, art collections, jewelry, things like that. That we joke and say grow legs and walk away when we're gone. All of these things can be down in family assets. So a few notes. So details are important. The more details, the better. List ownerships. Who owns the asset? Does it belong to both of you? Does it belong to one of you? Does it belong to the trust? Very important. Also, if it is an account that maybe pays a fixed rate of return, like a bond or something, or if it's a money market account that has a yield, maybe 4%, 5%, making note of that in the title can be important as well. Most importantly, list everything. This is the document that is a full, complete, comprehensive scope of all of the things that your estate planning attorney or your insurance agent or your financial advisor are going to have to look at and make sure that they're addressing the proper registration and everything. So be as complete as you can. If you think, oh, I have this small account, but it's not that big of a deal, well, that small account may be subject to probate. Maybe we want to know about it. So be as complete and as accurate as you can. So kind of getting over to the other side of the net worth statement, the right side is the liability side. So I've broken that up into two sections for this net worth statement. There's short-term liabilities, and then there's long-term liabilities. In general, a financial advisor might say, well, short-term liabilities are generally bad because it's usually credit card debt or car loans. Really, it's probably more about the interest rate that we're borrowing at as opposed to the type of loan. But certainly credit cards debts can be high interest rate and they can change a lot. I mean, even low interest rate credit card debt isn't low for that long. The healthier, longer term liabilities like a mortgage typically have lower interest rates. So again, here we're going to list, the mortgage on the primary resident and who has that mortgage in their name. Maybe it's John and Jane, maybe it's just John, and then the outstanding balance on that mortgage. So I'll point out one more thing before I move on this, is that understanding the difference between whether something is an asset or a liability and whether it goes on your net worth statement or cash flow statement is sometimes going to be tricky. So for example, you can have an item show up on both your net worth statement and your cash flow statement. Like for example, a mortgage has an outstanding balance. In this particular case, it's $350,000. Well, that is a liability that shows up on your net worth statement. But that mortgage also has a cash flow component or payment, and that's going to show up on your cash flow statement. There are some items that only show up on the net worth statement. For example, the bank accounts. In this example, there's $100,000 in the bank, and that's just a net worth statement. It's a liability or an asset, but it's not going to show up on the cash flow statement. An example of something that would just show up on the cash flow statement might be like a paycheck from work or a Social Security or a pension deposit. Okay, so I'm gonna do something fun now. I'm gonna back the date up. So this was a date of 2021. Sorry for flipping the slides. This is the same hypothetical example, but a few years earlier. When which is kind of a fun way. Like I'd mentioned that I've been saving my net worth statement for such a long time. I can go back for the last few decades and look at, here's where it was in 2000 and 1996 and so on and so forth. And it's fun and it's a nice history of what has happened. But it's even more important than that. What it also does is it gives me the ability to understand what I really need to save and what I don't need to save. So often we're tempted to save statement after statement after statement because we feel like we need the detail, we need the history, we need the record. Where having this single page summary of all of your assets year after year after year allows us to take those company generated statements and shred them because we've got everything here listed on one page. So that helps us reduce our filing cabinet space substantially. So we save the old one to see where we were, and then we put a brand new net worth statement right on top. So we kind of keep them in chronological order. If you have all of these net worth statements, you don't need to save your individual company generated statements. And that's kind of the point. So I want to go and talk about the liability side a little bit more and throw out a couple ideas just from the financial planning perspective, because I think we'll have an understanding of how to build the net worth statement pretty quickly. But a couple comments that we would typically talk to clients about is one is credit card debt, even if it's 0% interest rate, is not considered healthy debt. I think according to, and this is a little bit of an outdated figure, but creditcards.com suggested that 40% of households have credit card debt of $6,000 or more. And while that can be 0% now, it could be 20% or 30% next year. So not having short-term debt is a sign of a healthy balance sheet. So generally with credit cards, we want to be what we call transactors, meaning that we want to use credit cards to reap the benefits, because who doesn't like those airline miles or the 2% cash back or 4% cash back? So we want to get those benefits, but then we want to pay off that debt every single month, right? So we don't want to carry a balance and be charged a higher interest rate. Easy stuff. Last thing, and this is a really fun little nugget, I think, on the balance sheet, and something that we talk to a lot of people about is while we would tend to have, inherently the advice that, debt isn't necessarily good, it's leverage, yada, yada, but, not having debt can be good. Having a line of credit, if you own a home, can be kind of an advantage or a pretty good thing. So often we'll see somebody that will have a house with substantial equity in it. Maybe they have a mortgage, maybe they don't. Our advice often to them is you should establish a home equity line of credit, but don't use it, right? So then what we end up doing is we can go to the credit union or bank and say, hey, we want to establish a line of credit. So in the event that we need the access to quick cash, we can get it at a reasonable rate. But then we try not to ever use that. And what that does for us is it helps us realize that, well, if there's an emergency, I've got access to cash relatively quickly. So that's the home equity line of credit. And I don't necessarily have to keep a bunch of money in a short-term liquid savings account to make myself feel safer. Because a lot of times we tend to stash money away in savings or checking just so we've got that giant buffer, which is a good thing to do. But we can also think about a buffer just being a line of credit that's available to you. So home equity line of credits are inexpensive. Typically, their rates very similar to a mortgage. They're not high interest rate debt. They're easy to get. You can often get a home equity line of credit, 80% of your home value relatively quickly, and they're not expensive. Typically, there's no underwriting. There's no appraisal if you don't go over a certain threshold. So I'm not saying that you should go out and get a home equity line of credit and then spend it. We don't want to do that. What we do want to do is we want to have that home equity line of credit established while you can, so that you've got access to that line of credit in the event of an emergency. So one of the funnest examples I can think is we had a client who followed this advice, and then they looked great on paper. They had income, they had assets. The bank said, yes, we love you. Here's your line of credit. A month later, they got laid off, and they never would have got that home equity line of credit a month later. So they were really glad that they took advantage of the opportunity to establish the home equity line of credit. Okay, So again, you can get a template for this net worth statement on our website, or you can create one on Excel, or even, pen and paper works as well. Um, so one more slide. This is the same hypothetical net worth statement just a few years earlier. Note how all the accounts are labeled with the type of account and the registration. So it's 401k, Jack, kids UGMA accounts. Or we've got interest rates included on the mortgages. So one of the fun things I like to look at is, like, for example, here we've got a credit card and it says 9%. I can almost assure you that'd be a really inexpensive rate right now, because I've seen people with 20s and 30% interest rates on their credit card. But if I see, for example, that we've got a bunch of money sitting in a checking account earning 2% on one side, and then we're paying 20% on a liability, the advice is going to be pretty clear. It's like, well, hey, you shouldn't have that, high interest rate liability that you're paying money on when you're earning so little. So if the opportunity to earn more is greater than your debt, fine, keep it invested. But in this case, let's pay off that high interest rate debt. So this last slide on the balance sheet this would be kind of an early stage balance sheet. These people are just maybe out of college. They don't own a home. They've got 401ks started, and they're just getting going. And they've got a net worth that's negative as a result of those high student loans that we all come out of college with these days. Again, what I do is I take my balance sheet and I stack it up one on top of the other in chronological order. And then you get a complete up-to-date list of all your financial concerns and records in one spot. It's a great starting point for a conversation with any of your financial advisors, your trust attorney, your tax advisor, your insurance agent. One of the advantages of doing this is certainly reducing clutter, creating a roadmap for somebody that's going to take over for you, but also just having everything in one spot listed thoughtfully out. So when you have that meaningful conversation about your estate planning, or when you have that meaningful conversation about getting the right insurance, or when you have that meaningful conversation about your taxes, you can have all of this information at your fingertips to share with the professional that you're working with. So these are generated financial statements that you do yourself, the net worth statement. The other thing that we get that often comes up is, what's a company generated statement? And those are the things that are sent to us in the mail. So this is an example. This is something that just is going to come in the mail. It's a statement from my bank account. Now, what do we do this? What do we do with it? It doesn't replace the net worth statement, right? And the net worth statement doesn't replace these. This just has a lot more detail that you may or may not need. But the problem is that we might have 30 different accounts. So we've got 30 different pages where the net worth statement is all on one page. So it's much simpler, but it's still worth hanging on to these. So our rule, kind of what we do, is we have one copy of a statement from each financial relationship that we have, and we save that. So for example, I might have Abacus Credit Union and Bartholomew Credit Union accounts. I'm going to have one copy from Abacus and one copy from Bartholomew, and I'll stack those up alphabetically and save one copy.
Are you saying save the most recent statement or all the statement?
Yeah, good question. Good question. So we don't want to save all the statement. In fact, what we really want to do is just have one statement from each financial relationship that is relatively recent. And it doesn't have to be the most recent one. We just want it to be within a year, or approximately the same balance, the same reflection of what is going on in the account. It doesn't have to be the most recent. And so what happens is, as statements are coming into our household, either electronically or they're coming in the mail, if we had to take that statement and either print it up or take it out of its envelope and go put it into our playbook every time it came in, whether it's monthly or quarterly, we're going to create this, high touch thing in our playbook. And it's really not necessary, because all statements that are within a year are good for all the purposes that we need them to be good for. So as a practice, what I would do is I get my mail and I'll open up my mail. I'll look at a statement But then I'll recognize that, well, yeah, I just replaced this statement at the beginning of the year, and here it's only June or July. We're only a few months removed from the last time I replaced that statement. So I'm just going to look at the statement and look for any things that are going to alarm or concern me. And if they don't, then I'm just going to go shred it. So what we want to do is we want to keep one copy, relatively new, but only one copy. So why even keep a copy? And I think this came up on our last call. Somebody says, well, if I've got the net worth statement or I've got the Excel spreadsheet listing all of my assets and my liabilities, that's a pretty good roadmap right there. So what I would say is that it's a great place to start, but in the finance world, things still work off of statements in this day and age. So we're always looking for proof. I guess part of me thinks that, well, if I've got a statement from, in this case, First Bank of Wiki, I've got proof that I've got the account. Whereas if I just write it down on an Excel spreadsheet or a piece of paper, it's not necessarily proof. It's just my accounting, where this is proof. It also has all of the important information that we need on it. So, for example, it has the account registration. It shows who owns the account. It also gives me an account number. So in this case, I know the exact account number. And I've also got contact information for the bank. So it tells me how to get a hold of these people. So there's a lot of detail that we get on individual statements, which means that we want to keep one copy of each financial relationship that we have.
So some people turn off paper and only receive it electronically. So that means that they should download a statement, a recent statement, 3-hole punch it, and add it to the playbook. Yes?
I think you're right on, with the exception that I wouldn't 3-hole punch it. I'd stick it in one of my little plastic binders because the 3-hole punch just creates
Oh,
all this
yes.
confetti, right? So
Yeah, he mentioned that in the first session. Hope you all saw that.
so you can certainly 3-hole punch it, but the plastic little insert tabs are wonderful, and you can put so many pieces of paper in each one. Um, so yeah, if you get everything electronic, do yourself a favor and once a year, maybe just as they're coming in, print it up and replace the old one. It'll be nice to have. The other thing that I would say is that if you have a significant change in an account, it's probably a good time to update that statement too, because you want it to be somewhat of an accurate statement, just in case you need it. So again, the financial statements that we get in from companies, they're great because they have this account number, which is identifiable on them, and that's important. The registration is identifiable. The balance, we can see what the balance is, and we can see all the contact information. And we're also thinking that, oh, when somebody takes over, this is all information that they're going to need at their fingertips if they need to act on our behalf. So it's knowing who to call and what to call them about. So one thing I'll point out is that, so financial statements are, that come to us in the mail, they're printed in a specific matter or manner, and they include certain information. So financial institutions also allow us to have online account access, which is wonderful, right? We can log in anytime we want. What has been the temptation is to print up a screenshot of, the account and say, well, that's good. But keep in mind, often when you are logging in, you're not seeing a full account number, and that's not good. You're also not seeing, maybe specific contact information. So typically in our business, we don't consider an online snapshot of account view access similar to the actual statements that they're sending out to you. So be kind of aware of the difference. There's a lot more detail on the actual regulated statements that they're sending out to you. So if that wasn't enough, I was going to read a few pages from my book. Well, a few bullet points. So I'll stop there. Just some other things to keep in mind and some reasons why having a net worth statement can help you. One, you can identify who owns what assets and who belongs to each liability. And this can be very important in the past when it comes to estate planning, and is important when there are issues of who controls what in the household financially. So in a lot of states, federal estate taxes is such a high number relative that we don't worry about estate taxes. But in some states, like Oregon, for example, where the estate tax threshold is set at $1 million, it becomes a real pointed figure that we need to keep track of to help minimize estate taxes. So also, when you create a net worth statement, because you're labeling stuff and the registrations, you can start to identify what things are going to be subject to probate and what things will not be subject to probate, and whether it's going to be covered by your will or your trust. It's also a way to double check registration. So if you are looking through and you identify something that doesn't look quite right, you can flip back and find the original statement and verify. So it's a process to verify that you're kind of dotting the I's and crossing the T's. You also get a sense of how well leveraged you are or how much leverage you have. You get a sense of how liquid you are with keeping track of a net worth statement. You also get an idea of how concentrated your assets might be in one particular area. All things that can be helpful when it comes to kind of assessing your own financial health. So we keep track of statements on the asset side, and we also keep track of statements on the liability side too. So the same thing would apply. We've got assets on the left, liabilities on the right. We want to keep a copy of that mortgage statement, or a credit card statement. And again, not necessarily just a snapshot, because we want the account number, the contact information, and the registration. So again, I replace mine now once a year, and I always tend to do it in January. So kind of my little New Year's treat to myself during January and February, I just watch the mail carefully, and I go through and I replace all the statements that are older, knowing that everything kind of tends to come out by the end of the year. So then I've got up to date, and then the rest of the year, when I'm sorting through mail or emails, I'm typically, again, I'm looking at the statement. If nothing causes alarm, I'm just shredding it. So it becomes kind of I touch my playbook mostly in the beginning of the year. And then after that, I don't worry about it too much. It's up to date. So, okay. So we'll move on to the kind of the cash flow statement. So we've talked about the net worth statement quite a bit, right? And it's the bathroom scale. It's the figure that we get in the upper right corner, our net worth, assets minus liabilities. It's the figure. Unlike the bathroom scale, where sometimes we want it to go down, the net worth statement, we want it to go up typically, right? So that figure we want to see grow and grow. I like it. It's one critical piece of information right off the bat that we get. So it's the scale. On the other hand, the cash flow statement, or the budget, if you will, it's kind of like the nutrition log. It tracks, what's going in and what's going out, right? So you got income coming in, you've got expenses going out. So you think about like how the nutrition log and the scale work. The better you manage the nutrition log, the better the scale looks. Same thing with the cash flow statement, right? So the better you manage the cash flow, making sure that you're not spending more than you're bringing in, and the better the net worth statement looks. So the two work hand in hand. We all like hate the idea of budgeting. Many of us do, and part of this is budgeting, right? Because we're looking at what's coming in, what's going out. If you find yourselves consistently living within your means anyway, this becomes kind of a tedious exercise. And in this day and age where we all have Netflix and Disney Plus and HBO and Amazon Prime and all these things to keep track of, it can be challenging. I would say that early on in somebody's financial life, doing budgeting becomes really important because it teaches us to kind of live within our means. Later on, not so much. It's just an exercise. But the reason that we have this in our playbook, regardless of whether we need to go through the exercise or not, is to make sure that when somebody else is coming up to take over when we need them to, they've got access to one kind of an overview of, well, here's what's coming into the household. There's the pension or the Social Security or IRA distributions or rental income, so I can keep track of that. And then, here's what's going out. Here's the expenses, mortgage payment, or taxes, or Netflix, or Amazon Prime. So having kind of a record of here's what's coming in and here's what's going out is pretty important for somebody trying to assume the role that is easy for you because you're used to it. Um, so just like the net worth statement, where we're going to save one copy of each financial relationship, we're going to do the same thing with the cash flow statement. So, we're going to have maybe a copy of that pay stub that comes in, right? So we'll stack that behind the cash flow statement. And maybe we've got a copy of like a credit card statement, with account numbers and contact information. Again, we don't want to use credit cards and then not pay off the balance. We want to be a transactor. We want to take advantage of the perks, but we don't want to pay the interest. Um, so the cash flow statement is really simple. It's the nutrition log. It's just a summary of what's coming in and what's going out. The same methodology applies to the net worth statement, where we're just going to keep one copy, a relatively recent copy, of each financial relationship that we have. And that is the easy part. So once we do all that, we've got this process for somebody else to take over. They've got access to all this stuff. It's at their fingertips. You can get as granular as you want. But in general, we just want to have some sort of proof that we've got the financial relationship, and then a roadmap of how to contact all these important people. So that's kind of the overview, and we went through. That was about 40 minutes, 38 minutes. We kind of flew through, the net worth statement and cash flow statement. We really think those are the only two things that you need in the financial statements section of your playbook. We think that everything else kind of nicely fits into a different section. The hard part for most people is just creating that original net worth statement. Tends to be challenging, but you can do it as simply as downloading the Excel spreadsheet from our website, creating your own Excel spreadsheet. You can just pencil and pen it out on paper. It's okay too. But getting in the habit of doing it once a month, and then making sure that you're detailed about it, putting the registration, who owns the account, the approximate value, things like interest rates, whether it has a POD or a TOD designation, whether it's in the trust, will be meaningful for us down the road when we talk about things like, are we going to have probated assets? Do we need a will? Let's talk about estate planning. All that information is really important, and it starts with a net worth statement. So that's the summary. And I think, again, I feel like we covered a lot of ground. What do you think, Jeffrey? Any pending questions?
Yeah, well, Lakshmi was giving some suggestions about how to have an electronic playbook, and one of the suggestions was to include for the bank statements, to include the website of the bank where you can find the statements, which I
That's a
thought
good
was
suggestion.
great idea.
That is a good idea.
My only question would be, if you want it accessible to, if it's electronic and you want to make it accessible to, next of kin, or, important relatives, how would you would need to make it easily accessible to them somehow.
It's interesting. I think, from our perspective, one is I love how tangible the playbook is, and how it's right here. And I tell my spouse Marky, I say, if something ever happens to me, you go, you grab it. You don't have to worry about logging in anywhere. And I think for that reason, it's nice to have that physical version. On the other hand, if we have a fire at home and the house burns down and my playbook is incinerated, it sure would be nice to have an electronic backup copy as well. So we kind of, in our practice, we start here, but then we also use online software powered through eMoney, which is, we have folders set up to mimic the playbook. and we'll often back up what we do here on a digital format so people can log in from anywhere in the world. And the idea would be, well, if I need a copy of my power of attorney, I could be in Italy. I could grab it and download it at the local facsimile or whatever they do in Italy. So accessibility is enhanced by having a digital version. But it's a challenge because one, a lot of people are not comfortable yet, or we're not, we haven't gotten to the point where we completely trust, throwing all of our documents and stuff online. So, you kind of have to be prepared to say, okay, well, I'm gonna adopt this, and make everything digital. And that's not right for everybody because some people they can't get there.
We got a good couple of good comments here. Keeping your family, spouse abreast of Playbook on a weekly basis is key. It's not a one-time thing. We do this every weekend during breakfast.
Ooh, that sounds like my type of family. I love it. Hopefully the whole family is engaged in that conversation, and that you're lucky if they are. That's pretty neat. And I think once a week is pretty awesome. That's really keeping your eye on something that is really important, and I think that is really really cool to do. But it's a high standard too, Jeffrey. Wouldn't you agree that every week? I mean, you really have to be disciplined, and that's neat. But I would say at a minimum, to me, it's once a year you have to have those conversations, but it should be more often. So I'll go home and talk to Marky and see if I can incorporate that into our Sunday morning breakfast.
At least the spouse is involved, and we involve the adult kids twice a year.
That family meeting with the adult kids, I think, is really important. Um, I think we would encourage everybody to at least let their kids know, where the playbook is and the ref contents. Um, some families, want to nurture their kids along about family money. Some feel like, well, my kids are pretty good. They're going to have to take over, but they don't necessarily need to know everything. So depending on what your comfort level is, um, I think it's a wonderful opportunity to educate your kids as well and teach them a little bit about what you know already. So that's a good thing. And as we get older too, we need help, and so having prepared our kids a little bit more to help us more effectively is probably a pretty good idea.
I'm reading a comment. Yes, it must be done with adult kids. Exactly as we age, we need help. And then we have a question. Is the guide a step-by-step showing how to put it together? I'm sorry, is the guide a step-by-step book showing how to put together my mom's assets who has dementia so we can present it to a lawyer to gain access?
Yeah, I'd say the guide, or I'll speak about the book. I mean, I'm really specific in the book about how to make a net worth statement, and then how to create all the sections, um, to the point that you're simplifying everything and getting everything in one spot, and even some general advice on estate planning, not specific advice, but kind of how probate works, and some considerations for long-term care and other things that you may want to talk about before seeking professional help. But yeah, that was the idea of the book, is that we wanted to document the process that we came up with to kind of make sure that our clients were prepared, and that applies to our clients, but then also just people that just want kind of an education on how to get their finances in order.